Okay, hello everybody. Can I please get a confirmation that you can see my chart on the screen and that you can hear me, please? I'm just waiting for some confirmations to come in before I continue. Let's see, either there's a delay in the signal or nobody's here. One of the two. If anybody can hear me, please write into the chat that you can hear me and you can see the screen. Okay, first confirmation coming in. Cool. Okay, that sounds good. Thank you for those. All right, so welcome again. My name's Hubert Miranda. Some of you probably know me by now. I do some education for trading strategy guides. And today's topic will be about the MACD indicator. In fact, there was a bit of a misunderstanding at the back end. And I thought for a long time that we were going to do a webinar about the awesome oscillator. So I decided that I'm going to do a kind of overview of both and again a comparison because I predominantly use the awesome oscillator in my own personal trading, not because I think it's necessarily that much better or so, but just because I got used to it, so I know a bit more about it. But we're going to combine the two and give you a bit of an overview. I also wanted to just make clear from the outset that this is not going to give you a finite strategy and set of rules at the end of this webinar. This is basically really general knowledge that you can use then obviously to understand the indicators better and to use them and apply them to your overall trading in whatever way you see fit. So for people who were expecting like a sort of off-the-shelf strategy, that's not going to happen. My apologies if that was the expectation, but it's just going to be general learning about these indicators and how we can best use them in general terms. So let's get started. If you have any questions, as always, write them into the chat. And I will check them on occasion and address them as we go along. So on my chart here, let me just switch you over so you can see my mouse as well. I believe you should shortly be seeing my mouse on the screen as well. So what you can see here on the chart is basically both indicators. So at the bottom here, you have the MACD indicator with the black bars and the red line. Above it is the awesome oscillator, which, as you can see, is predominantly creating a very similar reading, just in different colors. And the first thing I wanted to show you is actually where to find them. So in your MetaTrader 4 platform, which is the most commonly used one, it's under this indicator options here. You go to, for the MACD, you go to oscillators, right at the top here, MACD. And basically you will get an options window appear like this. You can change the colors of how this displays and how thick the lines are and all of that. Here you can change the settings. I've noticed that the settings you see now here, 12, 26 and 9, they are sort of the standard classic settings. And I think when you click on reset, it brings you to them. However, last time, oddly enough, when I first opened the MACD, there was, I think, 70 and 33, 33 and 70 or something like that here. So if the default looks different in your platform, just try click on reset, because this was basically the original settings, how the MACD was originally created. And then once you've got all of that, you just click OK, and basically you get the MACD appear on your chart. I'm just going to delete that, of course, because I've got it already here. 1 second, let me just have a quick look at the chat. How does a MACD indicator... Okay, do you use moving averages? Okay, Chris, yes, I definitely use moving averages in my own trading, and in fact, obviously MACD and the awesome oscillator are all about moving averages. The indicators are totally based on moving averages, so it's a dance of many moving averages basically, and I'll talk about this as we go along. Then Rick, how does the MACD indicator differ from the squeeze indicator? To be honest, I can't answer you that question because I have not yet touched upon the squeeze indicator. So sorry about that, I have to skip that. Shaheen Alam, what is the exponential MACD? And okay, yeah, I'm sorry if you experience some buffering. That is, the connection is definitely fast enough, so I think once you see the recording, then you have you should have the higher quality. So if sometimes it gets blurry, please just bear with it, or try and maybe speed up your own connection by hooking up your own cable. Okay, then final question here. Have you ever used the MACD with extra MACD from a higher time frame? No, I haven't done that. But let's get going, and I'll get back to more questions later. So the first thing that I noticed actually when I started the MACD indicator on MT4 was that you actually only get one line. So you get the bars, which is called the histogram, and you get one line. And as far as I know, the actual MACD indicator actually should have two lines plus the histogram. And I'm sure you can get a MACD indicator somewhere on the internet that shows both lines. It is a bit odd because one of the functions that the MACD is using is for this crossing of these two lines. And what I've done, because they're based on moving averages, I actually just simply plotted these lines here in the chart at the moment. These two lines here, so the red line exactly, in fact, more or less corresponds with this red line, I believe. And these are basically the two moving averages that make up the MACD. So if we go back in here, we have a fast moving average EMA of 12, we have a slow EMA of 26, and then we have the signal line, which is 9. Oh, sorry, my apologies. This is the signal line, of course, the 9. So these two are separate. They make up the histogram, but they should, in principle, also show another line here so we can get these crosses. But I put them on the chart so that you basically understand what the MACD is doing. And so to finally get started, the MACD is an indicator that essentially gauges the momentum, as in the strength of a movement, of a price movement within a trend. And it's trying to find either spots that are good for buying or selling, essentially by looking at the crossover points of moving averages, like for example here and here. You would get that happening here as well if there would be the second line. Because if basically the faster moving averages crosses below the slower one, and in this case it would be crossing the signal line, then you have a classic MACD entry signal if you would just trade it by itself. But the first thing I want to kind of share with you is that I would personally never trade just on the standard MACD signal. I think it's a good tool to have in addition with other things. You probably have heard me said that before many times if you've watched some of my other webinars. I don't like strategies that are based really just on one thing, on one indicator or one tool. I want to see a correlation, confirmation across various things. And so the MACD is therefore one important tool in that regard. So the function, that's one function, that to basically once these crosses occur across the signal line here, then these often are either selling points or buying points if it crosses upwards. And then the other thing that the MACD is also used for a lot is divergence. And so divergence is this classic sense that probably a lot of you might know already, that you see price keeps on going up like this, but the readings here of the momentum indicators like the MACD are actually going down. So here, this spot here is lower than this spot here, even though price is rising. And that's called divergence. And this is basically the second function that you use the MACD indicator for, as well as the oscillator. Because as you can see, they're both based on this relationship between two moving averages, these black histograms and also the awesome oscillator here. And hence they're creating these intensity readings, so to speak, of how far apart these two moving averages are in relation to each other, and hence it gives you different readings. And so whenever price is moving in a certain direction and you get a peak in momentum, like here, right? You have a peak. This is where the moving averages would have crossed, separated the most from each other, and you can in a way see that here in these two moving averages that are visualized here for you on the chart, that the red faster one is the furthest apart from this dotted blue line than anywhere else before, and hence you get the biggest readout here. And so usually when you have a peak of momentum, you can expect that there will always be some follow through later on. So generally a trend does not stop when this peak of momentum is reached. It probably means that the trend is in its prime, and that you will then get a correction, but you will get another push higher in price beyond the high point of the peak. And the same of course applies if you are in a downtrend. But what will happen next is usually that you get divergence happen. And this is a beautiful example. The US yen from late March into the May 21st high. Like I showed you before, price is moving, it's reaching its climax here, peak here, then you get a drop-off in strength momentum, another push up, but you can see that the indicators are showing a divergence, and hence that's another signal how you can that you can use if you want to, for example, trade reversals. A key is to always wait for this divergence on one of your indicators, whether that's the awesome oscillator that you're using or the MACD indicator. You want to see this divergence, and I'm going to talk a bit more about divergence because there's a lot of confusion sometimes about how divergence is really gauged. So, but let me quickly check back on the questions to see what else we've got, what people are asking. So, yeah, so Chris, MAs are moving averages, and on my chart I'll show you what they are quickly. Yep, I'll show you the settings. So this one here the red one, is the 12 exponential moving average, and it's red line. I made it because it's the faster one, because it's a smaller moving average. I made it red, and I simply based that on. You can see here actually on the bottom here, MACD 12, 26, 9 tells you the three MAs that the MACD is using. Let me actually change that to a different color. Let me change that to, say, orange or something, so that we have a difference. Because this red line here is the 9 moving average. That's called the signal line of the MACD. Then the dotted fine blue line is the 26 exponential moving average. And yeah, that's basically it. I've just made them look differently, but you can change that to whatever suits you. And so yeah, in principle, you are dealing with these crossovers. Now, I myself am using a slightly different way of using moving averages. I can show that to you quickly here. You might have seen that in my previous videos. This is kind of more the template that I use. I would not be using the MACD, I would just be using the awesome oscillator. And what I've got here is kind of a similar thing to what the MACD does, but it's my own version. I'm using a 21 EMA. There are 2 times 21 EMAs, and I'm applying the price to the high and the low, so it gives me a band. And I'm gauging basically price in relation to that short-term band, and that gives me an indication whether the trend is continuing, or once it breaks below that, especially in the 4-hour chart, it gives me an indication that there's a bigger correction ahead. And I'm using that also in connection with divergence and strength momentum readings of the awesome oscillator. So I just wanted to give you also how I do it myself, just for your own reference. And we can talk about this if we've got a bit of time at the end. But let's continue first with the topic here. Go back to the chats quickly. Yes, Chris, they are EMAs. That's right, exponential moving averages. Okay, so let's talk a bit about this divergence, because that's a very big feature that all these oscillators, these momentum indicators, are used for. And often people think there is divergence when divergence is actually not confirmed yet. So what I mean by that is, for example, I'm trying to just find quickly something here that we can see that with. Okay, so you can see that on both of these. I'm just now going to refer to the awesome oscillator for a while, but you can essentially see that the histogram is almost following identically on both. So we've got a peak here, and you can say, okay, between, let me get rid of this line quickly. Oops, yes. Now I've got rid of the entire indicator. Let me put that back. Okay, so you can see at this point we had the highest peak. Then here you could say on the awesome oscillator, some people might say this is the beginning of divergence, and it's not incorrect, because price is higher and the reading is slightly lower. But you cannot call this confirmed divergence, because divergence is only confirmed once this reading actually goes right down to the 0 line. Ideally crosses it a little bit, but at least if it touches the 0 value, then you have confirmed divergence. So you could call it, you've got false divergence here. Then you see the reading drops down and price then rises again at this point. And so does the reading, but of course it doesn't rise at all as high anymore as here. And so we're getting closer to having real divergence. But even so, because this is still, so to speak, the same, if you want to call it that, like the same mountain chain, right? We haven't crossed down to the zero line yet. It's only at this point, once this entire swing, because when it crosses the zero line, this is the confirmation that the entire swing that started around here, that the entire swing is really over. This swing here. Before that, there's many examples that I can probably show you on other charts, where if you think of a live price situation, oops, let's go forward a little bit to about here, right? So look right here at the bottom right edge of the screen. So you could say at this point, yes, there is divergence because this is much lower than here, but you cannot know whether this is going to just continue shooting up and you're going to get a higher blue bar and another higher blue bar and another higher blue bar until you're back up at this level, and suddenly you don't have divergence even though it looked like it at first. That's why really you've got to wait to a point where things start to drop. You've got to at least wait to see a drop-off like this again. Like here, you see you're starting to get red bars again instead of an increase, which should happen if this is not going to turn into divergence. But you're starting to get red bars, which is the first, well, the second warning sign that really divergence is happening and the bigger correction is due. And then when does it happen? So here, right, at this point, so between these two candles, this is where we're starting to have actual divergence for the first time. No, sorry, we're not at this point yet. This only confirms the end of that swing. So in principle, if you're looking at this price movement from this time perspective, this is still part of the same swing. Therefore, within that swing you have divergence, but this itself isn't yet. I apologize for my mistake there and how I spoke it. But if we now go further and watch what price is doing next, then we're starting to get potentially true divergence. Why? Because this swing now has ended. I'll make some lines here to show you this. So here, this swing ended at this point on the AO. Then this next swing, we had a sideways correction, probably a triangle or so, and we continued next. So you can see the reading essentially goes up again, and now we're very close. Now we're right at this point where true divergence is finally confirmed, right? Because now you have two separate swings. You have this swing and this swing. And now you can compare them, and you can obviously see momentum is dropping and price is rising. And at this point, it's a very interesting point to enter a trade for a reversal, for example. And sure enough, see the price drop then much more intensely than here. It was quite short. Here you get the much bigger one because you actually are dealing with true divergence. Hope that was clear. Let's have a look if any other questions have come up. Okay, Rick, good question. Concerning divergence, how do you know what peaks and troughs to look at with the histograms on the MACD indicator at the bottom of the chart? Okay, so yeah, the MACD is slightly less responsive. So I'm finding actually the awesome oscillator is already not the most responsive. I myself actually using another proprietary indicator that's even more sensitive so that I can read internal structures. So to answer your question, I mean, the first part of my question was I would actually use the awesome oscillator, not the MACD. And so I will just minimize that for the moment to tell you how to read the peaks and troughs. So to read it, you need to consider, you need to essentially look at we should probably go to a live example to show you this better. But basically, I fully understand that at the moment, these readings, they look quite random. And the reason for that is because the size of this trend, relative to the size of this trend, and we're looking at it even on the 4-hour chart, it's a bit close up. So you're seeing quite a bit of detail of the movements within it. And so if you get a bit lost here, then try to go up one time frame. So in this case, I'm going up to the daily chart of the US yen. And let me get rid of these lines. Okay, so now you're only dealing, you're dealing with one swing. So always consider this zero line. Let me actually highlight this on the indicator because that's actually quite useful to do. So you right click into your indicator window, go to AO properties, and you go to levels, and you simply add a zero. So you keep the level value here at 0. Style, let's do that kind of a bit lighter yet, and make it a full cross line. So now I've got a 0 line marked here, and you can see it better. So you're looking for a significant turning point in movement on a time frame that if you get too busy, go up one higher and find a significant higher low. In this case, we had a significant low here. So then you can use the awesome oscillator to basically gauge where your swing starts and ends. And in this case, we have this entire swing going up to here and then coming back down. So for me, this is one swing. So you treat all of this as one unit, so to speak. Then when you're in a range and you start to get various crosses up and down like this, without it starting to become like a proper sort of rising mountain chain again, you should assume that you are in a sideways correction. And you can see that better here on the 4-hour chart when we look at the sideways correction. Oh, sorry. Here we go. So on the 4-hour chart, you're getting these crosses back down all the time, which gives you an indication that you're still within a correction because price is just simply not really creating a proper mountain chain, so to speak, like it did before. So in this case then, we have one swing here, and now we had another price movement up, and you can see how it's much simpler on the daily chart than what it looked like on the 4-hour chart. So in that sense, you then compare, because we have the separation, it went down to the 0 line, then it started a new move, and then you just do your divergence comparison, right? I hope that answered your question more or less. The key is to find, when you look at a trend, try to find the time frame in which you have basically one simple reading, in which it looks like one swing, right? In this case, the daily chart provides you the sense of this is one swing. As you go lower, then of course, yeah, you get this happen. You know, we're looking now at from here, from that low, at the same structure as on the daily chart, but you see you have so much more movement in here. And in essence, then you've got to treat each section as its own trend. And so you can do that. Unfortunately, we have an interesting structure here at the beginning. This is called a leading diagonal, or a wedge in common language. And unfortunately, this gives us an unusual reading, because it means in a wedge, in a contracting wedge, you know, your first move is the strongest, then your second move is the second strongest, and then your third move in the trend direction is the least strong, and hence you get strongest, second strongest, and least strongest reading. So this was the entire first part of that uptrend, followed by a correction. Then we had the peak, the major part of that uptrend, followed by another correction, and then the final part of that trend. And then obviously further things happen, but you can see how there are things actually happening within here that you can use in a similar way. So in this case here, again, we're back at this example that I showed you. We're now comparing these moves within the trend itself, whereas here, so we were looking at this divergence here between this top and this top, and then we may have wanted to trade this bearish correction. And you can see here on the daily chart that we can see that divergence too, but on the daily chart, it's not a true divergence yet, right? So you're getting, so to speak, an early false divergence. However, if you want to trade it on the 4-hour chart, it would be valid, because there you have a confirmed divergence. And for a true sort of proper reversal, I would usually rely on the 4-hour chart to show me confirmed divergence before I go against the trend. If you try and go against a major trend direction based on divergence of the 1-hour chart or lower, then you're in real danger, because it generally just means that it's just still a correction within still the same movement, and you will usually get burned. So that is important. I would say draw a line at the 4-hour chart and say, okay, if I got true divergence there, it's a good signal. Anything below that, I would be very cautious with. Okay, then Robert, do you think in the future you guys will do live trading webinars with the new trading system you have? You mean the Strike, Elite Strike trading system? Or do you mean what I've been, my own system, Robert? Okay, I'll just wait for your response. In the meantime, I hope that answers your question, Rick. So yeah, so this is basically the key for all these momentum indicators. You're basically dealing with moving averages, right? Relationships of moving averages to each other, and in that sense, it's also important to not forget that, to not forget that these indicators are essentially moving averages, but just visualized in a different way and not visualized on top of the price like here. So that you don't think you have like double confirmations when there isn't. So if you use those, then, and you say you want to trade a reversal, then I would just not just say, okay, I've got a divergence here and I can see a break of some whatever moving averages on my chart as well, and so that's like a double confirmation and I go for it. What's better is if you add in other elements. So you could say, for example, chart patterns like drawing trend lines and horizontal support resistance levels. So if we zoom right out here, for example, we can say, have we got a line that's of interest? Is there anything that we can see somehow that makes sense to this point? I'm trying to just draw some levels now to see if I get some more confirmation somewhere. I'm trying to connect significant price points with each other. So that's why I would, for example, do, okay, is there any trend line that lines up with a certain zone where a reversal could be likely? Now, this line is obviously the most interesting, so let me get rid of the others. Here, obviously this was a very important trend line. We had these key points here, and we had a break through that line, but then a collapse back in. So this is now a questionable sign. This is a fake out. This was not a nice situation for maybe people who were in this situation and thought, okay, this is now going further up straight away. But this is coming into an interesting zone. And I'll show you again why I chose that line. In fact, I'm going a bit further up in my time scale. I like to connect important key points, especially on high time scales. So in this case, what I like about this is that we have this distinct point where this weekly candle stopped right here. And this is connecting to quite a few weekly candles later on here. So we have a close right here. We have two close weekly candle closes again here at the line. Here we have two precise hits again. So this is sort of an interesting level for me. And you could even play with that. And if we bring it down to here, we can see, okay, see there is still points here. And because we're talking about such a big time scale, these sort of trend lines are really important. This does not make sense if you do that on a 15-minute chart or anything like that. But on a weekly time scale, these trend lines are relevant. So this is, for example, I just wanted to show you other completely independent elements of moving averages are, for example, these trend lines or horizontal levels. Of course, you can draw horizontal levels like so. And then if price, say, approaches then these levels, if it comes close to them and it's showing divergence, and maybe there is a Fibonacci level or something like that, who knows? We can use this entire move. So the 88.6 fell into that zone. Obviously, we've missed this, so this was not very tradable, in my opinion. But this is how you add different elements. Fibonacci is a different element, and so on. And that's really important, especially when you trade reversals. Hope that was clear. Okay, Tony, can you also do demo in NinjaTrader 8 using futures minis, e-minis? We might be able to do that. I have to talk to my colleagues. Right now, we can only do it in MT4. We could possibly do it in TradeView as well. This is a really good platform. But yeah, I'm sorry. Right now, we can't do that. Jonathan, does it work perfectly in all time frames? And if yes or no, what is the best time frame to use it on? Okay, so Jonathan, good question again. Like I said, if you're using the MACD or the awesome oscillator for divergence, I would say 4-hour chart is the best, or higher. Anything higher above up to the 4-hour chart is really, really good. If you're going to use this on smaller time frames, then for reversals I would not do it. For trend following, perhaps. So if you want to use the MACD, and if you get the proper MACD who has the two lines in here, you can use the crosses of the moving averages for potential entries with the trend, and that I can see that can work on essentially any time frame. I would stay away from 1 minute time frames for sure, probably 5 minutes as well. I think so from 50-minute upwards is okay. But yeah, I would only use it on time to gauge entries. I would only use it in a trend following method way, the MACD, by the crossing moving averages. And this is in a way similar to my own trading style. If I go back to my platform here, where what I do here when I want to do a trend following strategy, I've got a long-term moving average here, the 144 EMA and this 21 EMA band. And so when I see price align itself bullishly in this case, so price is above and the short-term moving average is bullishly aligned relative to the long-term moving average, and then I see price action like this. I see blue candles like this breaking above that EMA band again, then that's my way of entering trend following setups, and that works actually very well. But again, if you can combine other elements together, it's always better than relying just on one. So I think this is kind of more or less it. I hope this covered some of the basics. I could also briefly mention, if anybody's interested in Elliott, is anybody trading Elliott Waves here? If can anybody tell me that? Are you interested in Elliott Waves? Because I can then talk a little bit still about how those momentum indicators are actually really good aids for counting waves. If that's of interest, anybody let me know. Otherwise, I will wrap it up, unless you've got other questions. Okay, people are interested in Elliott Waves. Good. Okay, so let's do a little bonus on that. Let me quickly switch you over, and I will quickly try and find some images that will be of use here when I speak. Where are we? Okay. Just a second. Okay, let me switch you over again. Okay, so I hope you can see now this image. I'll just give the screen a few seconds to catch up with me. So this is a idealized drawing of a standard trend swing that's subdivided into an Elliott wave structure. So people who know Elliott waves will probably be familiar with this 1, 2, 3, 4, 5 sequence. And most of the time, so obviously I can't go into details now, so I'm just gonna say that for people who know a bit about Elliott waves already. About probably 80% of the time, the third move within a trend is the strongest. So in this case, we have an extended third swing, which subdivides into its own 5 waves. The wave 1 and 5 also subdivided into 5 subwaves, but these are bigger and therefore create a much bigger wave. And so this is important to bear in mind when you read the MACD or the awesome oscillator. There are some other forms as well, but I will talk about basically the most common form of a trend. And if we now go back to our chart, and in this case I will go to the euro-dollar chart to show you what I mean. And in fact I'll go quickly to the weekly chart, because this trend that we had right since 2017 to 2018, this uptrend, is a beautiful example of a 5-wave Elliott wave structure, and how the awesome oscillator is a great guide for that. So what happens when you look at the trend from the right perspective, so that you see it basically as one swing here, like I said before, from the 0 line, the entire trend is one swing. Then what you will correlate with Elliott waves is that the first wave generally still happens below the 0 line, especially when it's a big trend reversal. You tend to not see a reading on the AO for the first wave because it's so early in a trend. Then the third wave will always provide, not always, like I said, 80% of the time in trends, the third wave is the strongest. When the third wave is the strongest, it will always provide you with the strongest reading. So you will get the peak at the end of wave 3. And so when you have a peak and there's absolutely no sign of divergence whatsoever, and then you start to have a correction, you can be virtually certain that you will get, of course, the missing wave 5 still. And so this is therefore very good for gauging the state of an Elliott wave structure, the maturity of it. And so once we had a peak, and then we're entering into this final swing of the trend, that's when you have to, where divergence has to show. If divergence isn't showing at this point, then the trend is a much bigger trend and it will go on. But once you have a peak and then divergence starts to occur, this is the best sign that you are approaching the end of a wave 5, and therefore a bigger correction is due. So this is how the awesome oscillator or the MACD, you can see it's very similar, but I like the awesome oscillator more in a way because you get these different colored bars, and I find those very useful visually because they give you this immediate sense when there's the start of a drop in momentum. And so at this point here, of course, like before, if this is live trading, then of course we don't know what's happening yet in the future. And so at this point, oops, one more, yeah. At this point right here, we don't know yet what's happening because more blue bars are increasing. But the minute I see a closed bar that's red, and especially a second one, then my alarm bells are going off that now the chance of divergence is very high, especially once because of the complete structure here already. So this is very helpful for Elliott wave gauging. So then on the couple of other occasions, because in sometimes I'm trying to switch this slide if I can. So sometimes in an Elliott wave, and it's more rare, is that the first and the third wave are about the same, and then you get an extended fifth wave. In that case, you will actually get the strongest peak of momentum reading in the fifth wave. And that can be unfortunately deceiving, because often this can lead to one feeling that we have already a 1, 2, 3, 4, and then when a price is about here, we think, okay, a reverse might be due, because actually the reading can look very similar at this point, at the internal first wave of the fifth wave, as to when a reversal is about to happen, but then we get this push through. This is unfortunately something that requires experience and more gauging, but this is a warning sign. If you see that the first and the third wave are about the same size, then one warning sign to be more cautious about reversals is that the fifth wave is then more likely extended. And then finally, the last tidbit I wanted to give you is when in an Elliott wave the first wave is extended. Oops. Sorry, guys. Oh, now we're back here. That's where I wanted to be. This is an extended first wave, and in this case, when you get a really strong reading already straight from a reversal spot, so price went one way, is in downwards in this situation, and then you get a very quick strong move that's very long already, then you're probably dealing with an extended first wave, and therefore the third and the fifth will be smaller both than the first wave. In that case, your strongest reading in the awesome oscillator will be already here, and you will get generally a sense with experience of how these structures look. But usually when there is a very reactive move immediately that creates almost like a valley, that is a sign that you're dealing with an extended first wave, and therefore then again the awesome oscillator readings need to be gauged differently. Okay, and then the last final thing I'm going to give you today, I've got 50 minutes on the clock, is for people who also use Elliott waves and use triangles. What happens, the awesome oscillator behaves in a very particular way when price is within a triangle. And I remember a triangle here in the US yen. We had this triangle here. There was a big triangle. So what you start to get in the awesome oscillator reading is exactly that. You have a peak of wave 3, classic, and then you're starting to get these rounded hills in both directions. It's almost like as if you're a bit in, you know, you're like in between the flatlands and the mountains, and you're getting these gentle readings in both directions, and that's a very good sign that you're dealing with a triangle. And then of course you need to make your internal wave count to gauge the end, but when you, as soon as you start to getting these swings in both directions, this is a very good confirmation you're dealing with a triangle. Okay, so that was a little extra for Elliott wave interested people and the awesome oscillator. Unless there's any further questions, I will wrap it up. If you're interested in one of our trading systems, check out the link in the video box, below the video box, to the Elite Strike trade system. If you click on the link, it'll take you to a video, and it'll explain everything to you. And yeah, I hope you enjoyed this. Oh, another question came up. Naomi, what indicator is on the price chart? Well, there are several. Like I said, here you actually have lots of moving. So you have the orange one is a 144 EMA. These two are 21 EMA bands. This is an awesome oscillator. This is a MACD indicator. So you have 5 indicators on this chart, in fact. Hope that answers your question. All right, so thank you everybody for attending, and we'll see you next time. Thank you very much. Bye-bye.